Have you ever watched a stock market video and heard words like bullish, dividend, or PE ratio and felt completely lost? Don't worry, you're not alone. The stock market is full of unique terms that can sound intimidating when you're just starting out, but once you understand what they mean, everything begins to make sense. In this video, we'll go through 20 key terms every beginner investor must know, explained simply with practical examples from real companies. By the end of this video, you'll not only recognize these words, but you'll understand how they actually affect your money, your trades, and your investing confidence.
Let's start with the basics. The stock exchange. A stock exchange is like a regulated digital marketplace where companies list their shares and investors buy or sell them. In India, the two main exchanges are the Bombay Stock Exchange or BSE and the National Stock Exchange or NSE. The BSE is one of the oldest in Asia, while the NSE is known for its advanced electronic trading system. Think of the exchange as the venue where all trading happens, ensuring transparency, fair pricing, and proper record keeping. Without these exchanges, there would be chaos and no way to verify transactions safely.
You'll often hear people say, the Sensex went up today, or Nifty fell by 200 points. These two are market indices that measure how the overall stock market is performing. The Sensex tracks 30 of the largest and most actively traded companies listed on the BSE, while the Nifty 50 tracks 50 top companies from the NSE. If the Sensex or Nifty rises, it means most major companies' share prices are going up, indicating positive market sentiment. When they drop, it signals that investors are selling or uncertain. In short, these indices are like report cards of the Indian economy.
Market capitalization, or market cap, tells you how big a company really is. It's simply the current share price multiplied by the total number of shares a company has. Large cap companies such as Reliance or HDFC Bank are typically stable and less risky. Mid cap firms are medium-sized, often growing rapidly, while small cap companies are smaller but can offer higher returns and higher risks. Understanding market cap helps you compare companies more accurately rather than judging just by share price.
In finance, there are two main ways companies raise money, through equity or debt. Equity means ownership. When you buy a company's share, you own a small part of that business and share its profits or losses. Debt, however, means borrowing. The company takes loans or issues bonds and repays them with interest. Equity investors can gain from rising stock prices and dividends, but their returns aren't guaranteed. Debt holders get fixed returns but don't own any part of the company. Knowing this difference helps you understand how companies balance growth with safety.
An IPO, or initial public offering, is when a private company sells its shares to the public for the first time. It's a company's way of going from private to public, allowing anyone to become a shareholder. For example, when Zomato or LIC launched their IPOs, investors could buy shares before they officially started trading. Companies use IPOs to raise funds for expansion, pay debts, or invest in new projects. For investors, IPOs can be exciting opportunities, but it's important to research the company's fundamentals before applying, because hype doesn't always guarantee profit.
The terms bull and bear describe the overall market mood. A bull market is when prices rise steadily and investors feel optimistic, like a bull pushing upwards. A bear market is when prices fall and fear or pessimism takes over, like a bear striking downward. Both phases are natural parts of the market cycle. Understanding where the market stands helps you decide your strategy, whether it's time to be cautious or confident. Remember, every bear market eventually leads to the next bull run.
There are two main ways to trade stocks: intraday and delivery. In intraday trading, you buy and sell a stock within the same day. Your goal is to profit from small price movements, and all trades must be squared off before the market closes. In delivery trading, you buy shares and hold them in your Demat account for weeks, months, or years. Intraday offers quick gains but higher risk, while delivery is more stable and suitable for beginners aiming for long-term growth.
Before buying stocks, you need two key tools, a Demat account and a trading account. The Demat account safely stores your shares digitally, just like a locker for your investments. The trading account acts as your bridge to the stock exchange, executing your buy and sell orders. Brokers like Zerodha, Grow, or Upstocks offer both in one platform. Without these accounts, you can't officially own or trade any listed stock.
Every stock trade involves two sides, a buyer and a seller. The bid price is the highest price a buyer is willing to pay, while the ask price is the lowest price a seller is willing to accept. The difference between them is the spread. A smaller spread usually means there are lots of active buyers and sellers, which makes the stock liquid and easy to trade. If the spread is wide, it can be harder to enter or exit quickly without affecting the price. Volume represents how many shares of a stock are traded during a given period, say a day. High trading volume means strong activity or interest in a stock. Low volume means fewer participants. Traders often use volume to confirm trends. For example, if a stock price rises with high volume, it signals genuine buying strength. If it rises on low volume, it might just be short-term speculation. Volume adds context to price movement and is a key part of technical analysis. Volatility measures how quickly and how much a stock's price moves. Highly volatile stocks swing up and down rapidly, great for day traders but stressful for beginners. Low volatility stocks move more steadily and are preferred by long-term investors. Events like company results, global news, or interest rate changes can cause volatility spikes. Understanding it helps you manage expectations and avoid emotional decisions when prices fluctuate.
A dividend is a portion of a company's profit distributed to shareholders, usually once or twice a year. It's a reward for owning the stock. For example, if a company announces a 10 rupee dividend and you own 100 shares, you receive 1,000 rupees. Dividend-paying companies are often financially strong and consistent performers. However, not all companies pay dividends. Fast-growing firms may reinvest profits back into expansion instead.
The P/E ratio is one of the most used valuation tools. It's calculated as the share price divided by the company's earnings per share, or EPS. A high P/E may indicate that investors expect strong future growth, while a low P/E could mean the stock is undervalued, or that the company's growth has slowed. But remember, P/E must be compared within the same industry. A bank's ideal P/E is very different from a tech company's. Used wisely, it helps investors identify fair value. Diversification is the golden rule of smart investing. It means spreading your investments across different sectors, like banking, IT, energy, and FMCG, instead of putting all your money into one company. This way, if one sector performs poorly, others can balance out your losses. It's the reason mutual funds and long-term investors often hold 20 to 30 different stocks. Diversification doesn't eliminate risk completely, but it helps manage it wisely.
A stop loss is a protective tool for traders. It's a preset order that automatically sells your stock when it drops to a specific price, preventing large losses. For instance, if you bought a stock at 500 rupees and set a stop loss at 470 rupees, your broker will sell it if the price hits 470 rupees. This limits your loss to 30 rupees per share. Stop losses are essential for disciplined trading. They protect both your capital and your confidence.
Blue chip stocks are the giants of the market, well-established, financially strong, and leaders in their industries. Companies like Infosys, TCS, or HDFC Bank are examples of blue chip names. They have a history of steady performance, reliable earnings, and often pay regular dividends. While they may not give overnight returns, they form the stable backbone of any long-term investment portfolio. Owning blue chips is like owning the foundations of India's corporate economy.
Liquidity simply means how easily you can buy or sell a stock without changing its price. Highly traded stocks like Reliance or ICICI Bank have high liquidity. You can sell instantly at fair value. Smaller, less known stocks may have low liquidity, meaning you might wait longer to find a buyer. Liquidity is crucial for both traders and investors. It ensures that your money is never stuck when you need it most.
When placing a trade, you can choose between a market order or a limit order. A market order executes immediately at the best available price, fast but unpredictable. A limit order lets you specify the exact price at which you want to buy or sell, giving more control but no guarantee it'll execute. For example, if a stock trades at Rs 150, you can place a limit order to buy only if it drops to Rs 145. Choosing the right type depends on your goal, speed or precision.